Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Allied Properties Real Estate Investment Trust are plunging. Look at that. They're down almost 26.5% right now. This after a wider than expected loss in its latest quarter, driven by higher losses on investment properties. In addition, rental revenue fell 4%. Allied says it will issue new stock to pay down debt amid ongoing weakness in office real estate. It is executing a plan to strengthen its balance sheet and improve financial flexibility. Shares of Finning International are trading lower, down about 2 3/4. The industrial equipment dealer posted revenue for its latest quarter that beat estimates, but reported profit that came in below expectations. Revenue for used equipment also fell 23% compared to the year before, and sales for equipment rentals fell short. Despite this, Finning says its mining, power, and energy markets remain robust, and they expect markets for construction equipment to improve in 2026. And shares of Alimentation Couche-Tard are moving higher today. They're up about 3.88% right now after the gas station and convenience store giant unveiled its full-year targets. Couche-Tard plans to focus on strengthening its core platforms with an emphasis on investment opportunities. The move is projected to drive profit growth of 10% through 2030 and same-store revenue expansion of up to 3%. The company also expects free cash flow of more than $2.5 billion. And taking a look at the markets, you can see that the TSX struggling. It started the day off, but is being pulled down by Shopify probably and a couple others. Right now it's off by about 0.5 point. And looking at the U.S. markets, it is a very mixed bag. Not much really going either way here. S&P 500 off ever so slightly. The Dow Jones up ever so slightly. Dow Jones off by a little bit, and the Nasdaq is off by 0.2% today. And joining us now to break down key stocks in the energy sector is David Burrows, Chairman and Chief Investment Officer at Barometer Capital Markets. And David, thanks very much for joining us.
Happy to be here.
All right. It's been an interesting start to the year with the energy sector. What are we looking at? How is it done so far, and what are we looking at as we head further into 2026?
Look, it's really a continuation from what started in 2025. We had strong metals markets early in 25 in precious metals. It rotated into base metals. And as it goes with commodities, at some point you get energy to join the rally. And while crude prices are still, pretty low and not near highs, we've got many of the large cap energy producers performing really well, making new highs, and ultimately, getting some multiple expansion, especially those with long life assets, as it's becoming clearer that a lot of the shale oil producers in the U.S. are in decline and really are probably beyond their best days.
Now, we have seen a kind of a bit of a mini rally, I guess, for oil. Is that all the geopolitical, or are there other reasons for it?
Yeah, look, I think there's lots of cross currents in oil, but the energy sector became very, very underowned. Many investors were short oil, expecting a glut, which has not really appeared. As a result, a lot of people stayed away from the big cap energy stocks. But you don't have to look any further than the biggest to understand that something's going on there. And the fact is, these are huge cash generators. When in a world where we have persistent inflation, dividend growers by nature are the hedge, a rising stream of income against a rising cost of living. And some people don't think about it, but some of the very large commodities producers are big cash generators and will be prolific dividend growers going forward.
And is there any particular ones you're looking at?
Well, look, I mean, I think that for those that are focused in this space, there's lots of intermediate sized companies that are interesting. I think really you don't need to go further than the largest of the large caps, CNQ, Imperial Oil, Suncor, chugging along, ExxonMobil in the US. These are going to be great total return. But when you think about it, all of them have gone through paying down debt. They all are generating a lot of cash. They're all a little different. CNQ a little bit more focused on growth. But I think that Imperial Oil is a great example. If you look at what happened to Imperial in the last energy bull market, multiples doubled, dividends doubled, cash flows doubled, and you can do the math on that. It means the stocks went up a lot, and we are probably a year into what will be a very long-term bull market in this sector.
And of course, I mean, AI is what everybody's talking about, but you're cautious on the big cap tech.
Yeah, so we come at things from a macro perspective, and every asset class and sector and theme has its day in the sun. Realistically, as international stocks underperformed for a decade, and the U.S. really was the market to provide returns, international investors became very concentrated in the U.S., in particular in secular growth stocks. But the market has broadened. There are alternatives. International local markets, almost every one of them is outperforming the U.S. stock market today. U.S. dollars weakening versus every major currency in the world, including the Canadian dollar. And so you have to assume that from a maximum long exposure, international investors might be interested in taking some money back to their local market, benefiting from their own strengthening currency. The sector makeups in international markets really favor them right now because they're heavy in financials and industrials and materials and energy. So we think that there's a good opportunity there, and so when we look at large cap tech, they've gone from being big cash generators to starting to burn cash, and the multiples are contracting, not expanding. And when you look at the results that they reported in the most recent quarter, is reminiscent to me of the early 2000s, where companies beat estimates and got creamed the next day. It just tells you the next marginal dollar of demand for those shares is not there right now. It's rotating to somewhere that will treat it better.
All right, let's get in. You mentioned Imperial Oil, a couple of other stocks you're liking. Caterpillar is one of them.
Yeah, we are very focused in industrials as a firm. I think we're probably 16-17% focused in industrials, and spent a lot of time talking with them over the last couple of years. Caterpillar is one that we've used as a top pick on BNN. We own Caterpillar, we own Finning Equipment, we own Toromont. These companies will be big beneficiaries of the capital raises that have been done in basic materials companies. There's going to be a lot of mines built, and there's a lot of infrastructure being built around power. And Caterpillar sits at the middle of all of that. So again, earnings should grow, multiples should expand, and well suited in a world where there's an industrial renaissance going on.
Okay, we have to wrap it up there, but David, thank you as always for joining us.
Thanks for having me.
David Burrows, Chairman and Chief Investment Officer at Barometer Capital Markets. Coming up, Ford, the pioneer of mass car production, is still struggling to find its footing in the AI and EV era. We will break down its Q4 earnings and what's next for the automaker right after this. Ford's Q4 results were hit hard by supply chain disruptions, including a fire at a key supplier that led to aluminum shortages. The automaker continues to lag behind when it comes to EVs against Tesla, especially, whose market cap is more than 20 times larger. So can Ford close the gap as it tries to rebound in 2026? Let's break it all down with Mike Ward, Managing Director, Automotive Research at Citi. Mike, thanks very much for joining us.
Thanks, Roger. Thanks for having me.
There were some challenges, to say the least, for Ford. Did they kind of rise up to them, I guess? Do the numbers indicate they handled it as well as they could?
I think so. When I look back, I've followed the auto sector for 40 years. I think 2025 was the most difficult year that I've seen. If there's a downturn, you kind of know what to do. Last year, it seemed like the news changed every week. And so considering the environment they were in, I think Ford did very well.
And what were the biggest factors? I mean, that had that surprise tariff hit, the
Tariffs.
fire.
Yeah. Tariffs and the BEV and the changes in the regulatory environment, and then the fire at the aluminum plant, which hit their most important vehicle, which are the F-Series pickup trucks.
And those, I mean, that's the sweet spot for them, isn't it? Those F-150s.
That is the sweet spot. Absolutely.
And so, how are they coping with all that? How are they doing in your eyes? Do they look like they've seen these things, they're starting to deal with them, and in 2026 they're ready to move forward?
Yes and no. I think they've certainly made some progress. I think it was a smart move to take the write-off on the BEV side when they did. It never works when you're overregulated, and the entire industry was kind of subject to what government officials were telling them they would need 3, 4, 5 years from now. And so appropriately so, Ford, GM, others made investments for battery electric vehicles. And now that it's turned back to what consumer demands are, I think the industry will do a much better job. Just take the F-150 as an example. It's been the number one selling vehicle in the U.S. for decades. In part, it's giving the customers what it wants. That truck is what that market wants, and Ford does a great job with that. And so I think once you get the marketplace back into the consumers, I think Ford will do a better job with it. They do have a lot of good product. Recent products like the Bronco and Bronco 2 are spectacular products, well accepted in the marketplace. They've moved away from making small cars where they're uncompetitive relative to the Japanese or the Korean-based manufacturers. So yes, I am optimistic about the next 5 years, and hopefully they'll spend their money wisely.
Is there any concern with them moving away and becoming quite focused, or is that a good thing for them, do you think?
I think one of the things that 2025 taught the entire industry is you need to be flexible. You need to be able to adjust pretty quickly, whether it's changing government regulations or changing consumer demands. You remember the industry back in the early 1980s got caught flat-footed from smaller, more fuel efficient and better quality cars coming from Japan, and it took them decades to try to get their sea legs back. And so I think what we've seen now is we've seen the industry react a little bit more, a little faster than they have historically, and hopefully that's good news, and hopefully they'll continue that progress and won't deviate too far from what they do well.
And is there any challengers for the F-150? Anybody close?
GM and Ford dominated. GM and Ford dominated, have about 75% of the market. And Stellantis coming back with their bigger engines, I think, is a plus. The Detroit 3 have 93, 94% of the North American market for full-size pickup trucks. And Toyota, Honda, Nissan, others have tried in the past. But those are really good products. They do them extremely well. And again, they satisfy for what their buyers want in that segment. They hit the nail on the head.
Now, I mean, they're giving what the buyers want. Is that enough, though, or do they need to start looking for other markets and growing?
With the full-size pickup trucks, I don't think, you've tried to grow in other markets around the world, but that is certainly a North American product.
And then coming back to the EVs, do you think they'll get back into it, or hybrids is what I think they said they want to focus on hybrids. What's next in that direction?
I think, look, EVs are coming. EVs have been around for 100 years, and Tesla did a good job making them a product that consumers wanted to buy. Now the rest of the world is also making EVs that consumers want to buy. EVs are roughly 7% of the market. If you want an indication of where EVs are going, you look to California, where it's 20% of the market. And I think as you go out over the next 10 years, that's where you're going. You're going to about 20% of the market. General Motors and Ford have been focusing more on smaller vehicles that I think are a better use case for that consumer. Is a big full-size sport utility vehicle the right use case for an EV? Probably not. Is a commuter car or a small pickup truck the sweet spot for EVs? I think it is, and I think that's where GM and Ford are targeting, and I think they'll have better luck in those segments of the market.
What makes you think that?
Well, look at your history. Ford did very well with the Mustang Mach-E. GM is doing well with its small crossovers on the EV side. And it all comes down to a use case. And if you think about it, if an EV, if you're driving 75 miles a day and you can come back and plug into your house, that's a very different use case than trying to take an EV and drive it 1,000 miles where you're going to have to stop for hours at a time. I'm one of 9 kids. I can't even fathom what my parents would have done if they had to stop at a rest stop in a big station wagon and charge it for 2 hours. They'd be going nuts. And so that's not the right use case in my mind until the infrastructure gets where it's as easy it is to fill up your car with gasoline on the road.
Okay, Mike, we'll leave it on that note there. And I'm just having visions of 9 of you in the backseat. It was a station wagon. It was a station wagon,
yeah.
Wasn't it?
Oh, yeah. Ford LTD. Oh, yeah. No seatbelts, driving 70 miles an hour with the windows down.
Kids, don't do this at home. Mike, thanks very much for joining us.
Thanks very much.
Mike Ward, Managing Director, Automotive Research at Citi. Well, Bloomberg News is reporting U.S. President Donald Trump is weighing his options when it comes to CUSMA, including quitting it entirely. We discuss the likelihood of that outcome right after the break. Bloomberg News is reporting U.S. President Donald Trump is privately considering exiting the North American Free Trade Pact. This comes after U.S. Trade Representative Jamieson Greer said the administration would hold separate talks with Mexico and Canada. Here to talk about how the review in July might proceed is Lawrence Herman, an international trade lawyer at Herman and Associates. Lawrence, thank you very much for joining us.
You're welcome.
I mean, this isn't something he has mused about this before. Is it realistic?
I don't know whether it's realistic. I think the message is that they are looking at various options. I think from day one, it was thought that there would be difficult negotiations with the Americans. I think the possibility of withdrawal completely from the USMCA is pretty remote, but it is something that is obviously on the radar screen. And it was just a muse or a wondering by Mr. Trump if that might be an option. I think the more important thing, quite frankly, is the subsequent report that Jamieson Greer, the USTR, said the U.S. is considering separate deals with Canada and Mexico. And I don't think that should come as a surprise, although Canada has said that it would like to have the agreement continued as a three-party agreement, but the possibility of the Americans negotiating separately with Canada and the U.S., I think, was envisaged from the very start. When I say from the very start, when we began looking at the process of the USMCA coming under review.
Now, would that work? Would they be able to keep the 3 of them together if they're negotiating individually?
Well, that's a good question. It wouldn't be easy, but I think it could be done. Look, there are a lot of provisions in the USMCA that could be used in a bilateral agreement with Canada, as well as a separate bilateral agreement with Mexico. So I don't think mechanically it's going to be difficult to do that. But the point is, we will have an aggressive partner on the other side, whether it's a three-party negotiation or bilateral between Canada and Mexico, and we can expect very, very tough negotiations. And I think Canada has to be prepared to say, you know, these are red lines, and there are certain things that Canada cannot accept. It will mean that the negotiations, come on, they're going to be difficult, acrimonious, and at the end of the day, Canada is going to have to decide how much longer it can stay at the table if the other side is just unwilling to reach a kind of mutually satisfactory arrangement.
Now,
that's the big question.
Now, with you saying if it broke down to one-on-ones and these red lines and standing firm, does Canada have enough to stand to take a stand on things? Or do we hold any cards?
Oh yeah, for sure. I mean, the American industries across the board are dependent upon free trade and fair trade with Canada. I think there are a lot of interests in the States. You've already heard a lot of the pushback from what Trump has been saying from U.S. state interests, and there are a lot of major companies in the United States that have been saying trade with Canada is vital for their future. So there are a lot of things at play here, and a lot of American interests are going to be impacted if the free trade flows between the two countries don't continue. And you saw that when Trump threatened to stop the opening of the Gordie Howe Bridge. You heard the response from interests in Michigan, particularly the governor of Michigan, who said this is a non-starter. We depend highly on the flow of goods from Canada.
Now, we're going to do a what if here. What if CUSMA falls apart and we don't have any agreement with the U.S.? Would this free up Canada to be able to look to other markets easier than what we're trying to do now because we kind of have this sitting over here on the side? Would that open up more opportunities or no?
I think the opportunities are there now. And in fact, I think this government has been looking at those opportunities to diversify our relationships on trade and commercial matters. In fact, when you think about it, for decades, Canada has been regrettably wedded to the U.S. market. It is always a bad business practice to be so dependent on one customer, because that customer can turn ornery, as this customer, the U.S., has done. So I think that Canada has opportunities in other markets, but there are so many things that tie Canada and the U.S. together that I cannot see things going forward without some kind of agreement. It might not be a three-way agreement. It could be a bilateral agreement, as we mentioned before, that could incorporate a lot of the provisions on origin, on facilitating transboundary movement of goods, on services, on cybersecurity, digital trade that are in the USMCA, and they could be applied or incorporated into a bilateral agreement. That could be done. Technically, it is not unfeasible.
Okay, and what about if we do end up doing one-on-one negotiations? Is there enough for us to negotiate with Mexico as some kind of an agreement between the two countries?
Yes, we could do that. And, you know, the thing to remember is that we have a trade agreement with Mexico outside of the USMCA. Mexico is part of the Trans-Pacific Partnership Agreement. So if the USMCA fell apart, let's say, or we did not have a separate agreement with Mexico, there is that multilateral agreement or the regional agreement. Mexico is party to the CPTPP, and so there would be an ongoing arrangement between Canada and Mexico. It would be better to have a straight bilateral agreement if the whole trilateral USMCA falls apart. But let's wait and see what happens. In the meantime, for Canada, the priority is to ensure that we get out from this volatile, uncertain, unstable relationship and somehow, over the next few months, put together a reasonably consistent and stable framework for conducting business. I mean, that's really what's at issue. We want to have stability in the business relationship, which doesn't exist now.
I hate to cut you off there, Lawrence, but we have to wrap it up. But thank you very much for joining us today.
You're welcome.
Lawrence Herman is an international trade lawyer at Herman and Associates. Coming up, what does a decade of data tell us about Canada's automotive future? We'll find out after the break. Shares of Shopify are taking a hit, down 10.25 right now. That after the e-commerce giant posted profit in its latest quarter that came in below what analysts were expecting. There were a few bright spots in the quarter, however. Revenue topped estimates along with the company's sales forecast, and Shopify is buying back up to $2 billion US worth of shares. We're also watching Bombardier. It's down now, actually, ever so slightly. The jetmaker won a 40-plane contract for its Challenger 3500 aircraft from the private jet company Vista. The order's worth more than $1 billion US. We'll see Bombardier delivering aircraft over the next decade. The deal comes after recent comments by U.S. President Donald Trump. He threatened to impose 50% tariffs on Canadian aircraft, even decertifying. Gibson Energy is buying Chauvin infrastructure assets for $400 million. The deal includes the purchase of a crude oil pipeline and related infrastructure assets that connect Chauvin to the Hardisty oil hub in Alberta. The acquisition will enhance Gibson's heavy crude oil network by extending its reach to new and established producers. The energy company also announced a $200 million equity offer. Quick peek at the markets in the mid-afternoon, and you can see TSX is still off, but well above 33,000 south of the border. It is a mixed bag. S&P 500 up ever so slightly, almost a wash. Dow off by 0.2, and the Nasdaq down by 0.15. We are halfway through a decade of major change in Canada's auto industry, driven by electrification, shifting government priorities, and new global players. The federal decision to scrap the EV mandate marks another pivotal shift. To break down what it means for the sector, we're joined by longtime industry expert Charlotte Yates, president of the Automotive Policy Research Center and professor of political science. And Professor, thanks very much for joining us today.
Nice to meet you.
What do we have for the 10 years of data? What does it tell you about the industry here in Canada?
So the auto industry in Canada has really been struggling over the last 10 years. You've seen, I think, a little bit more than 10 years ago, we were producing 2.4 million vehicles, whereas today we're producing more like 1.3 million. So significant decline in production. This was certainly aggravated by COVID, by a number of decisions also made by the auto companies, in particular the big three American companies who operate in Canada, Stellantis, Ford, and GM. So decline in production. We've seen a very robust auto parts sector of kind of subsector of the automotive industry. And that's really driven by Canadian-owned, really strong parts makers, Linamar, Magna, Martin Rea, being able to produce parts efficiently, but also send them to the U.S. So it's bad for assembly. It's good for parts, but in the long term, there really is risk for the industry in Canada.
Just in general, what did the big three do? Did they move production south of the border? Did they move it outside of North America, or is it simply sales dropped?
I think if you look at the whole picture, where, of course, now the big producers in Canada are Toyota and Honda, and they have been for a number of years. While the big three have shrunk their profile and the number of vehicles they build in Canada, Toyota and Honda have maintained and, in fact, expanded their production over the last 10 years. So they're the real heart and soul, if you will, right now of the Canadian auto industry. I think what you see with GM, Stellantis, and Ford are a little bit different stories. Stellantis, and certainly since Donald Trump got elected and we saw the big three moving production from Canada to the United States. That's been a real blow for Canada, but it also speaks to long-term trends, I think. Let me look at Stellantis, for example. Stellantis is already in financial difficulty. They recently sold their share of a battery plant in Windsor. They've consolidated their production in the United States, and they have an idle plant in Canada. That company is already in trouble, so I think we shouldn't expect that we would see an increase in their production in any significant way, not just now, but in the near to the long term. Stellantis may be lucky to, in fact, survive this most recent disruption of the industry. So I think that GM has certainly shrunk its profile. And of course, Ford is retooling its major plant in Canada. All of this, though, revolves around what are the short, medium, and long-term plans of those companies and of Toyota and Honda, but also how is government incenting what the industry does. And certainly you mentioned at the opening, the big issue or question has been, where do EVs, electric vehicles, sit in this whole kind of issue of production in Canada. EVs right now are a long-term project, if you will, for Canada. We don't produce electric vehicles in any capacity. We had the one plant of GM's in Ingersoll, where they fairly quickly shut it down before it was even truly up and running. But it was also a very, very small market vehicle. It was not for a family vehicle, or a vehicle for individual consumers. So, and the government, of course, incented, and for good reasons, EVs, regardless of the current blip, if you will, and decline in consumer sales, they are the future. The future is EVs. And if Canada wants an internationally focused auto industry, whether it's with the big three or other players, including perhaps Volkswagen, it must have the capacity to build EVs.
Are we there? Do we have an industry capable? We're almost out of time, so I just want to get this one. Do we have the capability? Are we ready to do that, or are we too late to the dance?
No, I don't think so. I think Volkswagen's recent announcement that they could take advantage of the federal government's policy of incentives for buying electric vehicles, plus for getting duty relief if you build in Canada. Volkswagen, if it establishes here, will establish an EV plant, and it will be aligned with its battery plant in St. Thomas. So they could establish a whole kind of cluster of production in Canada, which is designed both for the international market, hopefully eventually for the US market, certainly for the Canadian market, but it will be focused on EVs.
Okay.
EVs will continue to be the future, notwithstanding the decisions made by Ford, Stellantis, and GM to pull back from those investments.
We have, Professor, I apologize, we have to wrap it up there, but thank you very much for joining us.
Thank you very much. Bye-bye.
Charlotte Yates is president of the Automotive Policy Research. Coming up, Hot Picks will zero in on 3 plays in the robotics stock. More on that after this. Now it's time for Hot Picks. Today we're zeroing in on robotics stocks. We were joined earlier by Zeno Mercer, Senior Research Analyst at Fatafi. We kick things off with Ondas as his top pick, a company he sees growth in as the demand for commercial drones continues to rise.
I'd like to assuage any fears around the scary elements of Ondas. They're actually more focused on kind of as you said, the counter side, like defense, not in traditional sense of attacking, but in the sense of we're going to see, as technology evolves, as we're seeing more AI and robotics applications, we're seeing new addressable markets expand and also new attack vectors. So Ondas has a mix of products. They've been rolling up companies over the last, let's call it 5 years. And now, so they do, monitoring for, railroads inspection. So they have kind of like a classic communications and inspection angle. But they also have counter UAV, so not attack drones, actually defending against drone threats. And as an example of that, they recently scored a contract with the Israeli border. And that's just one of many potential borders around the globe they could lock into. On that same subject, they're also bidding for things like the World Cup, the Olympics, and other things like that to help protect other assets like airports, stadiums, et cetera. So they've got a really interesting mix of ground and air robotics and control systems. And they're definitely right now a smaller company, but in that $4 to $5 billion range. But they have lots of opportunity to continue to grow into kind of that, let's call it autonomous robotics as a service market.
So these drones would be self-directed to a large extent?
Yes, they have a mix of autonomous drones that can sense, analyze, and act, let's say if there's a threat coming. But they also have other products too that are supervised. And let's back up a little bit. They're all supervised, so they're not fully autonomous in the sense that they're connected to a system and a network that whoever is the purchaser or holder of those assets can manage. But again, we're entering an era of let's call it hybrid autonomy. Where we're using assets like this for a number of different things. Like as an example, they scored another contract and have a division for demining. So not mining and creating weapons, they're actually helping eliminate mines that are in Israel and potentially places like Ukraine once the war is over.
That's interesting. I was watching a spy show with my wife last night, and we were wondering, will facial recognition change the spy business? Because if you want to check somebody out now, you can really you can do it much more easily. I guess they'll be putting facial recognition on drones, but I bet they are already.
Yeah, I would say that technology has been implemented for quite some time now. I mean, police force uses it on cars and scan license plates, facial scanners. I mean, you're going to have to do a lot more than even just wear a mask at some point from that element. So that's a whole different element or angle of computer vision advancements.
SoftBank, we think of them as a merchant bank, a major investment in tech stocks. Tell us what the robotics angle is, please.
Yeah, so exactly. But traditionally kind of telecom and then VC angle. Over the past 2 years, though, we really believe and see kind of this new framing and angle, vision taking shape. Obviously, they have their ARM position, which makes up a lot of the current valuation and is a great proxy for kind of this AI play. Now, AI is distributed in the physical world. We're going to keep hearing conversations around physical intelligence, which is essentially, AI acting on objects in the real world, aka robotics. Now, SoftBank also acquired ABB Robotics last year. And so now they have an actual robotics angle. They've got a green box. They've got a joint venture with Symbotic, another player, which actually was, I think, a year and a half ago, one of my top picks. Back in the end of 2024. They have a partnership with Yaskawa for physical AI, which is a Japanese, makes sense, another Japanese robotics company that's also in our Robo Index, ROBO. And again, they've got these 4 pillars. As he says, they've got AI chips, AI robots, data centers, and energy. And those are actually really, many would say, the 4 pillars of what a lot of GDP will be comprised of, is things that excel in those 4 areas.
And finally, an outfit called Novanta. What's their robotics angle?
Yeah, so I kind of wanted to include an angle that's a little different than maybe the application side of things.
Right.
Novanta is very much like a picks and shovel of robotics and physical AI. So they work in precision motion controls, machine vision, photonics, and a lot of tactile touch sensing. As an example, their biggest customer and segment is in surgical robots. And so what we see is if they can excel in surgical robots, and we see these new robotic applications coming, they're in a great position to be involved in and have upside that's really underappreciated in areas like humanoids, drones, and these other markets that are starting to appear. And in fact, in October, they hosted a, let's call it the Humanoid ISO Safety Standards Working Group. So this is clearly an area that they're looking for, but they really haven't, let's be real, they haven't started to get that upside in the numbers, but we think it's just a matter of time.
Fascinating. Yeah, just an exploding area. And I guess all of these companies are possible. Well, maybe not SoftBank, but Ondas and Novanta could even be takeover candidates for a company that wants to boost its robot portfolio.
Yeah, and I think we're going to see a lot more M&A over the coming years. Obviously, robotics is in the spotlight. I think everyone's talking about it, from big tech. Even the U.S. government is looking at having a national robotics strategy. There was a bipartisan bill introduced last week. We really are entering, let's call it, this Cambrian explosion moment of robotics because of that convergence of AI chips and new form factors and like world models coming together to increase the capabilities and coordination and management of these robots.
And that was Zeno Mercer, Senior Research Analyst at Vitafi. Coming up after the break, we'll break down Shopify's latest results as the company beat on revenue in Q4, but missed on profit. More perspective when we come back. We are watching shares of Shopify after the e-commerce company reported its latest earnings. We got some reaction from Siti Panigrahi, Managing Director at Mizuho Securities.
They beat across the board. Its GMV was 31% versus expectation was around 28%. But also, if you look at merchandise, merchant solution revenue, that was up 35%. versus expectation was 32. So it was a pretty strong quarter across the board, but also the guidance was strong too. They guided also above expectation. That was another reason you can see a strong beat as well as guide. So revenue low 30% versus expectation was mid 20%.
Now, Shop Pay gross merchandise volume was up more than 60%. But I mean, I'm not a huge internet shopper, but I don't recall seeing Shop Pay as an option. But maybe I just haven't been on the right sites.
Yes. So what Shopify is trying to do is for the merchants, they're offering different channels for them to sell to different consumers. So, and Shop Pay payment is one of the key driver for merchant solution growth. Whether you have your own website or you're trying to sell it at, whether at the Google search or social commerce, they're everywhere as a checkout button. Yes, I mean, you have not seen that, but probably you're not shopping at one of the Shopify merchants. But yeah, that is one of their key strategic, goal at this point.
Shopify stock, maybe we'll put up a 5-year chart, is down from its highs. Why are investors more cautious these days than they were more than a year ago, for example?
Yeah, I mean, if you see last few years post-COVID, stock came down because, in fact, their growth decelerated. But last few years, since post-COVID, if you look at the GMV growth, has been accelerating from 19% to, last year, 24%, and 2025 was 29%. They're trying to re-accelerate their growth. But lately, what you have seen is that AI disruption. That has been a, right now, key concern across software, and investor looking at Shopify as another software platform for merchants. I think that is why at this point you see stock underperforming.
Actually, sorry, the stock actually peaked more recently in late October at about 249 Canadian. So it was pretty recent, the peak. Do you feel those fears, those software, AI disrupting software fears are overdone?
I think so. I mean, there is a little bit of, I think it's overblown, but the way investors look at first is, they try to penalize everyone in overall software, then they'll try to handpick, look at individual companies. So Shopify, they think it's a software platform, but effectively, if you see, this is the execution platform for any e-commerce vendor right now, any merchant. So it is not a software that you can do vibe coding. They own the mission critical execution layer at this point. And the other point is agentic commerce. That's the new trend that's coming in, and they're investing heavily there. If you think that's the next future, from social commerce to search commerce to now agentic commerce, they're well positioned there. So time will tell, but I think, yes, at this point, the fear is a little bit overblown.
And agentic is where the AI just acts as a sales or really a customer assistance person. It's not a person, but it'll help answer my needs. And it won't just address questions like it's talking to everybody.
Yeah, so you think of that's from a consumer perspective for you and I. But for a merchant, if you think that's the future, a merchant wants that channel. They want to capture that channel. If you're in the Google search, they want to be seen. If you're at the TikTok, they want to be seen there. Now, if you think you and I are going to go to ChatGPT for our shopping, a merchant wants to be there so that you buy their products. And what Shopify does, it helps those merchants. They help enable that agentic commerce as a channel. So whether or not we'll see how the adoption will take off, whether you and I will use an agent to buy goods online, but at least this enables those merchants, Shopify enables them to be available at that ChatGPT or Claude.
And he was speaking with Siti Panigrahi, Managing Director at Mizuho Securities. Now, Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. And that, my friends, wraps up this edition of Trading Day. Have yourself a great afternoon. Thanks for watching.